Well, I think everybody knows they're going to cut rates by 25 basis points. It's pretty interesting that just a few weeks ago, people were talking about a 50 basis point potential cut and even an intermeeting cut that was sort of in the wind there back at the end of August. But now the bond market has really taken away the possibility of a 50 basis point cut with the backup in rates that's happened globally of about 25 or 30 basis points over the last couple of weeks. So the Fed has a pretty easy job this time. Bond market says one cut, no need for anything drastic, and yet the stage is perfectly set for that interest rate cut today. The real question is what's going to happen with the dots. I kind of think the Fed almost wishes they hadn't come up with these dots thing because they've had a hard time predicting what their future path would be pretty much for the past year. So we'll see what happens with the dots. You might remember that at the June meeting, the idea was that they wouldn't be cutting rates here in 2019, but then just one meeting later, they had to cut them once, and they had no cut for 19, but one cut for 2020. It'd be interesting to see if they bring that cut in 2020 forward to 2019. I think that's going to happen, and maybe say that 2020 they won't have to cut rates. Economic data got really soft globally there for a while, but it has improved a little bit if you watch it closely in the past few weeks. So the sort of urgency that was out there for more drastic things went away, except for, of course, that kerfuffle with the repo market not having enough reserves and leading to this amazing spike in the overnight rate yesterday to almost 10% briefly before the Fed did the repo work. So one thing that might have to happen here is the Fed might have to start QE-lite, as I call it, meaning that they go back to expanding their balance sheet in line with the increase in currency to get the reserves, the free reserves in the system higher than what seems to be this toggle point of where it is right now at about a little under 1.4 trillion. They'll probably have to get that higher. It'll be interesting to see if Jay Powell talks about that in the press conference. I think he has to.
I think he'll be asked about it. I mean, more QE is not the only solution, you would admit, to what's taken place in the repo market. It's the one that you've mentioned. It's, I think, maybe undoubtedly the most dramatic one, but it's not the only solution. And how worried should we be about it?
That's a good question, how worried you should be. Clearly, short rates getting out of the Fed's control even briefly is problematic, particularly because of the template of the past when it happened back in 08 surrounding Lehman Brothers. It doesn't seem at all like that's likely to happen here. But the problem is that there's not enough reserves in the system, clearly, to provide the liquidity. And what they used to do before the global financial crisis was, again, I'll call it QE-lite. What they do is they expand the balance sheet in line with the growth in the currency. They could always do some sort of permanent repo facilities and the like.
Right.
But it just seems to me that the Fed is almost anxious to start increasing their balance sheet again. You know, back in January, in a U-turn from the December disaster where they said QT forever, in spite of economic realities, you know, they started talking about the potential of QE not being an extraordinary policy anymore, but a regular policy tool. So it would just seem that the skids are greased for the Fed to go and do that growth of the balance sheet in line with the growth in the currency, like they did prior to the global financial crisis. But the fact that short rates are spiking obviously is in no way a positive. The fact that the reserves seem to be at the right level, except that they're not, there obviously are pockets in the system where the liquidity isn't there. And that's always a cause for concern, especially because the markets are in a fairly stable place right now. You would imagine what would happen if you were in a situation where there was a real squeeze at a quarter end or a year end or during a risk-off sort of an experience in the markets. So the Fed will address this, I think, but I think it's going to be through expanding the balance sheet because they want to go that way. Look what Draghi just did last week. I mean, he said $20 billion of QE, 20 billion euros rather of QE per month on an open-ended basis. I mean, it's starting to see. It was interesting. I was in Europe at the time last week, and I was meeting with a lot of very, very major asset allocators. And I noticed a real change in sentiment regarding what's happening with negative interest rates and ECB policy. The change that I observed was there's been a pivot away from this idea that the circumstance that we're in the ECB and the banking system there is temporary. Last time I was in Europe, there was this feeling that negative interest rates were sort of a novelty. that you had to kind of live through and suffer through and endure if you were a financial institution. But the mood now seems to be that there's an awareness growing that this is a fundamental policy, that central planners want to get the inflation rate substantially higher than the interest rate, or put another way, to keep the interest rate very much below the inflation rate for negative real interest rates. I think they're starting to realize that this debt problem that we have in the developed world is really starting to show up in the financial system. Just look at the underperformance of bank stocks as a sector in Japan, in Europe, pretty much persistently ever since interest rates went negative. They're starting to realize that this is sort of a situation we've got ourselves in that has a long-term problem. Weirdly, there's a contradiction between the long-term problem being exacerbated by short-term solutions. I mean, the way that central planners are dealing with the long-term problem of negative interest rates being fatal to the banking system is weirdly more negative interest rates, because they think that's going to help in the short term. But eventually, as we know, and this is a theme that I've been thinking about a lot as this year has progressed, eventually a lot of short-term solutions that exacerbate long-term problems lead you into a reality where finally enough short-term things lead to the future, the long-term, being now. And I think that's starting to happen with negative interest rates, and the solution in terms of slowing down the long-term coming into our reality is to keep interest rates well below the inflation rate. In other words, negative real interest rates as much as possible, which is a really problem for investors who are fixed income focused, like they are particularly in Europe, where they're basically saying that the objective of the central planners is to make bondholders lose purchasing power systematically over time.